Our first panel, I'm very excited to welcome our two speakers, Magali Langhorne. She's a managing director at Deloitte, my fellow partner. She's an industry-recognized expert in AML and financial crime compliance with more than 20 years of subject matter experience and expertise. Many of you probably recognize her face. She's a former lead AML regulator at FRB New York, responsible for the LFPO portfolio and global seminar contributor, providing AML training and counsel to C-suite leaders and board of directors worldwide. Magali strategically advises clients navigating significant regulatory scrutiny in critically demanding times. Sitting next to her is Matthew Probershteyn. He's the head of institutional cash management and non-financial risk and controls for corporate bank at Deutsche Bank. He's risk management and financial crime compliance leader that has been working closely with Patricia Sullivan at Deutsche Bank for about 4 years. Prior to that, he spent 10 years at Standard Chartered, where he held various leadership positions, including global head of correspondent banking, head of financial crime compliance, governance, and operations. Additionally, Matt spent time in various compliance positions at Barclays, Societe Generale, Mizuho Bank, ABN AMRO, Citibank, and JPMC. So very rich experience. Looking forward to your point of views. We have a few topics that we would like to cover. And in a way, it is a continuation of the panel that we had this earlier today when we were talking about the current landscape, regulatory landscape, and enforcement actions and examinations. And I just want to double click and maybe get a little bit deeper on some of the topics we covered in the morning. And Magali, maybe I start with you. Given the messaging that we are hearing from the new administration, we are hearing about the higher threshold for materiality with respect to MRAs, MRIAs. What should we be expecting when it comes to the exams specific for AML and financial crimes? Should we be expecting a lighter touch?
So first of all, thank you so much, Miriam, for the warm introduction, and to BAFT for having me. I'm really looking forward to this discussion with you, Matt. And I'm here to repent for my regulatory sins, my past regulatory sins. So that was a joke, but maybe it's a little too late. So in practice, and what I'm going to be much more transparent than my former colleague was perhaps this morning, just because we're in different places, and I left the Fed a year and a half ago. So that's going to color my comments. In practice, I don't expect the actual execution of examinations to change drastically, if at all. So what I'm saying is logistically and operationally, the execution of examinations for BSA AML will most likely not change. There are a couple of drivers for that. So as we all know, there's a statutory mandate to conduct an annual BSA AML examination of a supervised institution. And the one thing that regulators, well, maybe top 5, that they don't want to have to do is answer to Congress for missing what we call an examination mandate. So unless legislation, changes there, there will most likely be, or there has to be, some type of annual touch from an AML perspective of a supervised institution. Secondly, that's not to say the scope cannot be flexible, right, in the examination, especially if you are under an enforcement action or if it's BAU. But there will be an execution of a review at an annual, from an annual perspective, from your supervisors and your regulators. What I do think, and again, this is from my own experience, I'm just speaking personally, as an examiner during Trump 1 in 2016, I would not be surprised to see a difference in materiality of findings and or discussions around potential enforcement action decisions. And what do I mean by that? So Internally, once an examination has concluded, the examiners have to go through multiple internal vettings, right, with their stakeholders. That could be, for my experience, the Fed, it was, board legal, New York legal. If we're doing a joint examination, the other regulator. And those vettings, we discussed the materiality, the assignment of materiality on findings. And I think we all remember the guidance on guidance around 2018. And there was an intangible but very clear, how should I put it? I'm choosing my words diplomatically. The bar was much higher, right, to assign, for example, an MRIA to issues versus an MRA. So that's what I mean. So the examination process will not change. It's a statutory requirement. If there is a change, it would be around the materiality, the assignment of materiality to particular findings. And then that, of course, leads into the enforcement action discussion realm. I have heard completely informally, a potential change in the appetite for enforcement actions. Now, I'm speaking specifically for the imposition of a new enforcement action. If a firm is already under enforcement action, obviously there's a statutory requirement to continue monitoring that enforcement action. There might be a further discussion on what does sustainability look like, right? Just as long as, along the lines of materiality, maybe it's a shorter time frame. But I think those are some of the potential changes you might see in the short term, just based on my own experiences in 2016.
Okay, so no real change to the examination approach or timing, perhaps maybe slightly change in scope, but mostly seeing the outcome.
Right.
And the ratings that are coming out will be impacted. Matt, what has been your experience? Have you seen any changes since the new administration?
So first of all, I'd like to say thank you for having me on this panel. It's a privilege to share the stage with such world-renowned financial crime compliance leaders. So it's great to be here. I think I'll start with just the regulatory landscape. So there's so much changing, right? I think if you're in this industry for a long time, you're always seeing change, but the pace of change now, whether it's crypto guidance, whether it's Corporate Transparency Act narrowing, whether it's sanctions development and extraterritorial reach that is coming with it, or whether you're seeing SDNs designated as terrorists, whether you're monitoring the tariff situation and expecting tariff circumvention monitoring, all of this is changing landscape, and it's kind of going to dictate where we're going to go in the next 1 to 3 years. So I think this regulatory position that we're seeing with this new administration, we'll see more of this change. I think, it's probably going to settle down in the next 12 months as I think the agenda starts to land more. But right now, I think everyone's kind of like at the edge of their seat watching what's happening. When it comes to the approach of regulatory exams, so I've been examined for over 20 years, different banks. And, if you've been in this industry again for that long, you've seen the shift of joint regulatory examinations then to independent enforcement to now, I would say, more collaboration, and a situation now where I think, depending on who your primary regulator is, you still see a good amount of coordination, but you're going to see, I think, continued independent enforcement and penalty and so on. When you zoom in to the ground level of regulatory engagement, that's evolved also. And I think it's evolved because of events like the Silicon Valley Bank crash, like other market events. And I think the industry has looked at the need for regulators and institutions and their representatives to be closer together. So the engagement is now more dynamic. It's monthly, it's quarterly, it's during annual examination. It's if we have a problem, we call. If the regulators see something, they call us. And that partnership, I think, is essential because when you step back and you think about the financial system and what we're all here to do, everyone's got a role to play, but we're only stronger if we're playing our roles together. And so I think that's the way forward, and I think that's the way we'll see the next year plus evolve.
Miriam, if can I just follow up, because it's something you said is so important, Matt. It's the ongoing regulatory engagement with your supervisors, or I should say engagement. That relationship is one of the most important investments that a firm can make, especially as we speak now, right? There's a lot of uncertainty. I think, I'll use the word, well, it's just uncertainty, I think. And as a former examiner, I can only imagine the amount of stress that they're undergoing at this very moment. Help them help you at the end of the day. And if you keep nurturing that relationship, especially in this stressful time, right, for regulators, that will pay, in my opinion, that you will have a significant return on your investment. You help them tell your own story. You don't want them telling your story, especially right now. So, don't wait for a meeting for them to ask for a meeting, right? Proactively reach out, communicate. Even if you want to, discuss potentially the implementation of a new control, whatever it may be, use that opportunity to engage with your examiners and your supervisors to the best of your ability.
I fully agree about what you said, tell them your story, reach out proactively. I know that with some of the institutions I currently work with, we are putting together a closure narrative, even though we were not asked, and doing it before the first day letter, right? Exactly to give ourselves an opportunity to tell our own story rather than waiting for the questions and just answering questions, but absolutely.
If I can add one last point, the way I think the industry needs to see this is if the bank fails, the regulator fails. If the regulator fails, the bank fails, because the regulator is there to make sure everything is going right. And if something is going wrong, and the regulator who's regulating, hundreds of other banks, if they do not see the issue and they don't spot it, and it becomes something that becomes sensational news, it emerges publicly, and it's got some significant impact to the bank, its financials, and so on. This hurts the regulator, right? So imagine then the regulator's responsibility and the questions that come to them. So this is actually a shared responsibility, right? And if they don't regulate and they don't enforce, then banks that are doing the right thing have a bit of a disadvantage versus banks that are operating a little bit more loosely. So that's why it's got to be a shared responsibility. And if we fail, they fail. If they fail, we fail.
Matt, let me stay with you. On top of the regulatory changes, which you have very clearly laid out, thank you for that. We are also seeing some internal forces. I'm sure you're experiencing pressure to reduce costs, to rationalize staffing, do more with less. How does that impact how you go about building your financial crime program?
So this is an industry that I think has a lot of tensions, financial inclusion and de-risking, information sharing, data privacy, and probably within that top three is cost versus compliance. When you invest in compliance, you're not buying a car that you can drive, you can have that new car smell, you can park it in your garage, you can hug it, whatever you want to do with your new car. You don't do these things with compliance. Compliance is like insurance. And so it's hard to measure how compliance is protecting you. You usually do it in hindsight. So if you have a successful compliance program, really what's happening is your business is thriving because your business is not operating under conditions. They're open-ended. They can reach for their ambitions in any way they want, but it's well controlled. And so embedding this into the business, to me, is the key. For, I think, far too many banks I've worked at, I have seen that second-line functions have been siloed away from the business, not participating in strategy setting, not participating in the financial equation, so on. And then business looks at compliance as an expense. This is the wrong way. So if you truly are a business that is going to thrive, you need to embed your financial crime risk management into the first line. So my role is unique. I have a dual role. I am heading up the institutional cash management business for North America at Deutsche Bank, but I am also the head of non-financial risk controls for this business globally. And so if for those of you who know me in a room, I am 25 years financial crime compliance, but I'm helping enable the business in reaching its ambitions by protecting it and making safe strategic decisions. And because of this, I'm able to prove that risk management is equally as important as sales, product management, technology investment, and so on, because we're not siloed. We feel it, we execute in the first line, and the bank sees the benefit of this. Of course, we must also invest in the second line to keep the independence, the check and challenge, and make sure that what we're doing is correct with expert advice when we need it, and so on. But this balance has to be correct. And I think institutions struggle when they don't find this balance and where management see compliance as an expense instead of a business enabler. So that's the argument to me. If you want to get investment, if you need to evolve your risk management processes and techniques, you need to show the balance between first and second line, and you need to show the responsibility of the first line of defense.
Amazing. Magali, what do you think when you hear about this approach of embedding compliance in first line?
I think it's a phenomenal story to tell, right? It's all about how you tell your own story. And before examiners even get in the room on the first day, that's the story they want to hear, quite frankly. And that's the story then that you tell and you describe with, fully supported, right, your approach and why it works for your institution. And then that's the story that they will then retransmit, to their own internal stakeholders. There were so many times during the course of my supervisory career where the first line was simply absent from major discussions, including closeouts, where we were discussing the issuance of enforcement actions. And that will tell a supervisor or regulator all they need to know in terms of materiality. That is a massive, massive gap. So it resonates because it's probably the structure that I wish I had seen more of, quite frankly. But that can only benefit the firm overall from mitigating associated AML risks. So again, we're going to keep on this theme of telling the story, demonstrating the story. Why does the story work for that organization, and setting that tone and that narrative?
Awesome. For the next set of questions, I would like to talk a little bit more about the new administration priorities. And Matt, you have already mentioned and referenced some of them, whether it's the crypto and digital assets, it's the sanctions and the tariffs, etc. But before we get into the topics, maybe we can pull our second polling question just to get your perspectives as well a little bit. Which of the new administration priorities are the most impactful for your institution? And we have crypto, digital assets, we have cartels, we have fentanyl supply chains, sanctions. Okay, sanctions still very much in lead. Okay, as we are still getting some responses in, I think the decision has been made. Sanctions win. Magali, maybe I start with you. Given the speed and volume we talked about, the speed and volume in the past couple of months, past 100 days, really has been unprecedented. What should the banks be doing? How should they be reacting to the changing administration priorities?
Yeah, so if I were still examining, I would most likely tailor my first day letter to reflect, a request, a walkthrough, or an examination or testing of the actual processes that a bank has or a financial institution has to respond to the various priorities that are coming out by the administration, whether it's an EO form or a GTO, for example, or addition, a new sanctions program, right? So the underlying process should not change. It's the effectiveness and the adequacy of how an institution executes that process to absorb these new developments in a timely and reasonable manner and in an effective manner, quite frankly. That's how the examiners will test you. So, for example, I wouldn't be surprised to see deviations in first day letters where we might not have included them a couple of years ago. A walkthrough, asking for a walkthrough, how to respond to, a recent GTO issuance, or, which if they're good, they'll add that to their overall, like, for example, your subpoena response process, right? It's the underlying framework as to how the firm is absorbing these and how they are implementing controls in response to the priority. What I will say is, historically, and I think this is a valid criticism, the examinations, again, just speaking for myself, examinations, now on the other side of here, compliance for compliance sake, right? And didn't necessarily include how effectively a firm was aiding or reflecting law enforcement priorities, right? Those were historically, when I was examining, separate. So, even though, for example, FinCEN may issue, or acknowledge a firm's very adequate processes that helped, a DOJ case, for example, right? That's not what regulators are examining for. And so I think what you will see, what I hope, because I do acknowledge that that is a disconnect, is going forward, a reconciliation of the two. That the priorities, the administration's priorities, no matter what administration it is, incorporated into a firm's AML program, and incorporated into the supervisory process as well, so that there's a decrease in the disconnect between compliance for compliance sake, and that's why I'm being examined, versus incorporation of the priorities for law enforcement purposes.
That's helpful. That's very helpful. One of the priorities that we actually even included in the poll was related to crypto and digital assets. What are you watching closely with regards to crypto and digital assets? What should the banks be watching out for?
So when I think of it, it just, again, I'm speaking from a regulatory and examination perspective. AML is great because product or service or various customer type, the application, the risk-based application of your controls should be tailored to whatever that underlying product, service, or customer is, right? So to me, crypto digital assets is just another form. I think what's most interesting is the appetite right now from an environment perspective and administration. So always look for the appetite. What is the appetite coming out of I'll just use it like a general, out of DC, right? Okay. So, the FBA's rescinded their guidance requiring, or their statement requiring a supervisory non-objection, for example, when a firm decides to engage in digital assets and crypto. That is an appetite signal, right? So that does not replace the need to have adequate controls when engaging in higher risk activities, and that's what you will be examined on. But the appetite is there to indicate flexibility with a firm's decision to engage in XYZ. And that's, I think, the most important. And one should take advantage of that current appetite and flexibility, and also have a story to tell when engaging in it, and why the existing controls or the control framework is adequate to support the engagement in XYZ, because that's what you'll be examined on.
Matt, given all the signaling that we are getting from DC, as you said, right, do you feel that the banks are ready to move forward with some of these new products in the crypto and digital asset space, or do you feel like you still are in the waiting game and waiting further guidance?
Yeah. So we just saw the Federal Reserve change it or rescind its guidance that it was issuing years back, And I think it was very specific towards two areas of crypto. And it was right to do because the whole space has evolved and they recognize that. And I think that's really a great position. We know that they're working with the FDIC and OCC to issue new guidance and continue exploring the space. But when I step back and I just look at the whole crypto arena, right, banks are entering the space. Banks support fiat to exchange conversion. But if we really want to be effective in combating crypto financial crime, we need to partner with the exchanges more. So there are like 25,000 different virtual currencies traded on over 250 exchanges. Forbes quoted around 500 exchanges. CoinCap quotes around 250 exchanges. So let's say somewhere in between. There's 659 million people owning, or at least estimated people owning crypto, one of those 25,000 cryptocurrencies. And they're transacting through 150 million wallets at a 3 trillion market cap. So if you think about those stats for a second, and you step back, and you think about the concentration of, let's say, somewhere between 250 and 500 exchanges, those are the exchanges that are really taking the risk to transact that crypto activity. The wallets aren't really regulated. The creating a virtual currency is not regulated yet. And banks will continue to process fiat. So if we really want to make a difference in the space, I think we need to partner with the exchanges. I think some exchanges, like if you look back at correspondent banking providers, should consolidate so that they understand that offering crypto trading comes with the responsibility to have safe and sound compliance programs with that. And there should be greater regulation towards wallet providers and virtual currency creation. Until that happens, I think it's a great avenue for a criminal to use to wire funds or move funds back and forth through crypto, exchange through wallets. So I think this is an area of focus that we will see emerge quite specifically in the next, in the next type of guidance.
Can I just add something?
Yeah, absolutely.
So to tie it back to our earlier conversation around communication and that relationship and the strategy. So, even though they did rescind the basically let me know so I can object, right, around engaging in crypto and digital assets requirement, always a great idea to go through exactly what Matt just described if a firm is contemplating it and socialize that with your local examination team or your local regulators. You're not asking for permission, clearly, but something you said at the top of the hour, and I'll just say bluntly, examiners hate one thing more than anything else, it's being surprised. And so if they're surprised by a development in the program or foray into a new product and or service, they then have to tell their own stakeholders XYZ. And so everyone down the chain is surprised. And that is not a great position for a regulator to be in, to your earlier point. So would definitely just keep focus on that relationship, that regulatory relationship, regardless of the product or service that you're engaging in or thinking of engaging in.
Great advice, great advice. Let's move on to the next topics that are also on top of administration priorities. We've mentioned cartels, fentanyl supply chains. Matt, maybe I start with you this time. What should banks be looking at in terms of their exposure to these priorities?
Yeah, so, I like the question a lot that we had just, the one we just polled. So it mentioned sanctions, cartels, fentanyl, and crypto. And actually, these kind of like at times can go all together.
Yes.
So in terms of priority, they can all be the priority because they're all kind of connected in a way, or they can be. So I think banks need to anticipate, right? They need to understand their risk appetite. They need to understand their business trajectory. And then they need to anticipate the evolving areas in the space that in which they're doing business. So if they are entering a new country, if they are entering a new product, they need to be able to understand, the inherent risk of that. They need to understand what the current administration is what their thoughts are around that type of product and space, and so on. If you think about defense for a second, the world will be moving into spending more money on defense. Countries will be scaling up their security efforts, and the administration in the U.S., either they're going to be selling defense in one way or another, whether it's the materials, whether it is security. They want countries to pay for that. And so we will see defense spending, but then you will see actors emerging that are, from the black market or new players and so on that want to also participate. And, if you're going to enter that space, you got to know who they are. You got to know where to look. You have to understand which countries are higher risk and so on. So you really need to anticipate and dive into areas that could present elevated inherent risk. You also should monitor the results of your controls in a way that brings everything together.
Mhm.
So if your controls are showing a sanctions event or a SAR or some type of ABC event or so on, and you're not bringing this together by product, by client to form the full view, then you're going to miss out. You're not going to connect the dots. So you need to understand what your controls are telling you so that you can respond effectively to the risk that's being presented and don't run away from it. You need to partner with your client. You need to partner with your regulator to go and tackle that risk. Because if you run away from it and you de-risk, the only thing you're going to do is move that payment, that transaction to another institution, and then they're hopefully going to identify what you found and try to deal with it. Because the money always flows through the financial system. Access is difficult to prevent fully. It arrives in different ways through payments. So disrupt the risk, work together to fix it. And I think if you anticipate, respond to your controls, whether it's this administration, the next one, the prior one, your program will be able to respond to any dynamic nature of financial crime and mitigate it.
And that process, if I may, is so fundamental to the implementation and execution of an AML program, right? And you mentioned de-risking or debanking, right? That conversation has come up again recently, right, around debanking or alleged debanking. So I think you're exactly right. These are questions, and these are the type of analysis that a firm really wants to document and document well all decisions for risk mitigation purposes for various reasons and for various audiences. It's something that we've been discussing in the industry for years now. It's been a bit of a resurgence lately, but the way to control that narrative is exactly what you said and has not changed fundamentally.
And if I may echo something Magali said also, that engagement takes the right people in the right roles. So you may, have leadership that are not really paying attention to the geopolitics of what's going on in the world, and then weaving that into their strategy and their compliance program. You have to have the right engagement, the right. You have to be informed by the right information, and at times, the leaders of the organization will be relying on others to help inform them. So don't shy away from sharing that information internally, especially when you see control results flagging, right? Don't try to just move past the alert or whatever the issue is. Let management know what the problem is so that you can all collectively respond and think about how to pivot the business in the right direction.
To add to the study that you started in terms of looking at things holistically, right, across, as you said, across all of the priorities, can you comment a little bit on, you mentioned tariffs earlier in your remarks. What is your perspective? Like, what is the potential for leveraging the existing AML, sanctions, financial crime tools and detection processes when it comes to what we are now hearing about, tariff evasion, avoidance of tariffs?
Yeah. So look, when I think about this, I think a little bit of secondary sanctions related to Russia and supporting its military industrial base, because you're not going to see the details in the payment. And the goods are typically disguised in terms of where they're originating from and where they're heading to. So if there's, for example, a tariff on a country and the exporter in a country wants to circumvent the tariff, so they're just going to open up a company in a different country. They're going to falsify the origin of goods from that country that they're purporting to operate in. And the payments will look like they're being imported, exported to that other country, and that's how they avoid the tariff component. It's the same as secondary sanctions, right? It's disguised, it's funds moving, seemingly not for the purpose and nature that they're destined for, and it's hard to monitor, right? When you think about the Russia secondary sanction situation, OFAC didn't come out and say, stop all payments to from Russia. They said, make sure you're not supporting Russia's military industrial base. And the industry started to go and figure that out. No one wanted to be the institution that received the penalty 5 years down the road for shipping dryers to or from a destination. But those dryers they had the chips extracted from those dryers, and those chips were being then implanted into Russian missiles to help guide them. Who knew, right? And no one wants to pay that multi-million-dollar fine. So banks responded by saying, we're not going to make payments to or from Russia anymore. Right? And then they do post-monitoring to see if there's any proxy countries, heightened goods, and things like this. Imagine this magnifies across all countries for tariffs. You're going to need to invest into your sanctions program in a real significant way. So I think it won't be easy. I think if this is to come, Treasury and industry and banks and regulators should get in a room and figure out how to do this in the most seamless way to create the most effective control environment.
I'm chuckling to myself because one of my mentors at the Fed would always tell me, for sanctions evasion purposes, what have you, Magali, you always have to look at the misuse of the 202. So I would go in and I would do my examination, and I would ask for literally a data dump of the 202s, and I would read every single field, right? And always told me about field 72, to see whether or not there was some type of misuse of the 202 for evasion purposes when there should have been a 202 COV. So, exactly what Matt said, these are processes that most likely already exist within your programs.
Exactly.
Now you're tailoring them to another typology, basically.
Exactly. I mean, evasion has been always there, right, in different forms and shapes. So let's use the tools we have. Before we move on to the next topic, we have one more question, but I wanted to make sure we address the first question because it is related to digital assets that we were discussing as part of the priorities. Magali, maybe I turn this one to you. Does the presence of multiple regulatory authorities overseeing digital assets, such as SEC, CFTC, FinCEN, contribute to the advancement of the technology, or quite the opposite?
So I'll be diplomatic in my answer. Let's see. I think the fragmentation, right? I think that it doesn't help things from a regulatory and oversight perspective. How should I say this? I think a more streamlined approach will benefit all parties involved, right? I think I'll leave my answer there.
I echo that.
Okay, all right. Sounds good. Maybe we move on to the next topic. Regulatory relief and innovation. So earlier today, we had multiple panels. We had the head of AI strategy for JP Morgan talk about the importance of AI, Gen AI, and how it's important for financial institutions to engage with the new technologies, right? To make sure that you do it in the proper way and you have the right subject matter experts on your team. Can we talk about the innovation and the use of new technologies within the financial crime space, right? Especially, maybe Magali, you can start here. Given some of the recent executive orders, right? Like there is messaging around unleashing financial sector and liberation of regulatory environment and the use of some of the new technologies. Can you speak about that a little bit?
Yeah, so I'm going to go back to the point I made around appetite and the signaling. There was I'm going to get my years, I don't want to misspeak, but there was a joint statement a couple of years ago around, innovation and the uses of innovation in AML programs and encouraging it from a reasonable, sound, safety and soundness perspective. I think that still holds true. Right now, the appetite, I think, is much more much more flexible and much more encouraging, right, to the application and usage and the discovery of AI within AML programs and innovation and technology. I say that with a caveat that take advantage of the appetite, but take advantage of it responsibly. And again, that is something that applies to any type of innovative enhancement to a program, because they will come in and test the usage and the implementation of any type of technology, AI or otherwise, to make sure that it is soundly executed and implemented within a firm, tailored to the risk profile of the institution, and still mitigating appropriate risk. So what does that all mean? Everything documented, rationales documented, usage documented, validations conducted, you know, a sound oversight framework. Definitely need. I think the days of an AML program for an examination perspective where you only have the BSA officer in the room are long gone. If I were examining a firm today and we were talking about the implementation of AI or any other type of technology, at a minimum, I would expect the head of technology in the room. At a minimum, I would expect data governance. So that's the evolution. So I say all that to say there is an encouraging appetite. Take advantage of it, but responsibly and in a way that is defensible to a third party, whomever that may be.
Other areas within financial crime program that you would say are do, and other areas where you would say don't? I don't know, transaction monitoring versus testing. Matt, I know you have some specific case studies that you wanted to share.
Look, you know, like when I think about AI in financial crime compliance, I think of a text message. So when you type the word smile and then the smiley face emoji comes up, that's AI, right? That's like the core foundational first type of AI. When you process a payment and there's narcotics trafficking linked to that, you're not getting the narcotics trafficking emoji. It's just not going to pop up, right? The payment data is never going to tell you that, or the shell company, or the human trafficking, or the fraud, whatever it is. So I think in this industry, we really need to speed up, because in fact, what's happened is AI is used against us. And I was involved not long ago in a situation where we're talking to a wealthy individual. They want to bank with us. And we're meeting them on video, and it's like a movie star, and we're so excited to see them. And right, face, voice, everything's perfect. They are wearing a blue sweater. The window in the back is halfway open. The fan is spinning. First conversation is perfect. KYC documents come in. They're perfect. Passes the bank's tests. Second conversation. We speak to the person. Same blue sweater. The window is open halfway. The fan is spinning, but it's 2 weeks later. So now we're like, this person really hasn't moved, huh? And we're seeing them all over the world in the news and so on. Then we say, okay, let's slow down because our senses are up. Now, third time, same thing. Now we're like, okay, something is really wrong here, and we don't proceed. Because really the best combat against AI is the computer in our head, right? This computer here gives us the best common sense to say something really isn't right here. And by the time the machine learns that or detects the voice over technology or the video deep fake, it's going to be too late. So I think we need to reinforce our controls, knowing that we are behind on AI technology used against us. And we need to speed up to find a solution to be able to combat these type of trends, because this is the number one, I would say, most prevalent financial crime event occurring, and organized criminal organizations have invested into doing this in mass volume against banks, people, and so on. They take the digital identity and they use it against them. So we really need to speed up to be able to combat this. But while we're speeding up, we need to reinforce our controls to make sure that we really protect the people who are using our accounts and ensure that they're not defrauded.
Maybe they really like the sweater.
They could like the sweater, yes, yes.
That's fascinating.
All right, well, with that story, I think we are almost up on the time, so I'm just going to ask one last question. If you had to predict the financial crime landscape in the next 1 to 3 years? What should be planned for? Is it going to be political? Is it going to be criminal? Is it going to be COVID-like? Matt, would you like to start?
Yes, so we tried to also get this view from everywhere in the world, every client we meet with as we travel and have these roundtables. I don't think it's going to be a natural cause like COVID. I think it's going to be more political driven, linked to sanctions and the evolving environment. We see the correlation with tariffs and so on. But really, I think it's all the same underlying crime. It's just different tools to help enable it. So if we're going to combat it, there's so many different ways, but the number one thing for me is to do it together. So at Deutsche Bank, we have this concept called an ecosystem of risk management, where your risk is our risk is your risk. And as I said earlier, if we move risk to other institutions, we ultimately don't protect the financial system. So when we see a problem, we need speed so that we connect with each other to be able to disrupt that issue. Because by the time the criminal steals the money, and then we, within our organizations, discuss that problem, and then you get a law enforcement subpoena, perhaps, maybe you don't, and you file a SAR, the money's gone, long gone, spent, right? And the victim is suffering. And so we need to work together with speed, connectivity, right? And I offer the simplest approach, just call each other, right? You see a problem, you just call each other. Recall the funds, disrupt the financial crime, call your regulator, tell them you see a trend, contact your law enforcement agencies that you're working with. You just need to proactively connect everyone. And only then, I think, with speed, we will start to disrupt criminal organizations more and make it a lot more painful for them to operate. And we'll see this starting to trend down instead of trending up and up as we're seeing over the last few years.
Thank you. Magali, any final remarks?
Just quickly, I completely agree with you, Matt, and just want to emphasize the collaboration aspect. And from a regulatory or an ex-regulatory perspective, I think what I hope short-term looks like is the continued evolution of the regulatory framework to respond directly to the evolution of the underlying criminal or alleged criminal activity, right? That impacts the U.S. financial system and how it's done. And I'll just go back to the earlier point that, yes, that I think it's a fully valid point. There is a disconnect between, national priorities, administrative priorities, whatever, regardless of what administration is in, and the regulatory framework from a supervisory execution perspective. And so short term, these things take a little longer than short term, but I hope that there's a continued evolution, and those folks they work hard every single day, trust me, you may not see it, but they do, to get to a point where the framework is responding to the most serious threats that our financial system faces. So I hope to see a continued evolution.
Sounds great. Well, with that, we are out of time. So big thank you to Magali and Matt. Please join me in a round of applause.
Thank you, Miriam.
Thank you.